Wednesday, November 11th. Nothing's changed. Still looking at the dashboard. The dollar and the 10-year, they look like they're back in sync. The dollar, after a week of being down in face of the uncertainty around the election, is now finally looking like it put in a floor and is starting to make higher highs. The 10-year, I guess it's maybe 3 or 4 days behind because it's still in the putting the floor part of the cycle. Gold is responding nicely to movements in the dollar, though. That relationship has held up because I saw a big drop in gold on Monday, which corresponds with the 10-year, which, I mean, that looks like it's based around liquidity, though. Because you had the news about the vaccine, the change in sentiment, and there was a risk-off mode. There was a risk-off move in markets. Actually, yeah, no, it was risk on because gold is falling. So gold goes up and risk on because it's anticipating increasing inflation. So gold's going down. So that's risk off. Yeah. So the dollar should have been going up. The dollar's been flat all week. Same with the 10-year. Should have been going up, been flat all week. S&P is up. Crude oil is up. So it's to the point where it seems like the stock market and oil are the markets that are still a little bit dislocated. They're booking their fundamentals. They're both up. The dollar's starting to appreciate. That's leaning into the risk-off trade, which is the coronavirus trade. Same thing with the 10-year bonds. They should start appreciating. Risk-off. Investors seeking liquidity and safety. Gold should sell off because we're in a deflationary cycle at best. I'm sorry, we're in a disinflationary cycle at best. At worst, we're in a deflationary cycle. So, gold as an inflation hedge really has no place in the portfolio. And also, there isn't industrial demand for gold to support the prices with coronavirus. So, yeah. And then oil, I don't know. There's no reason why oil should be going up right now, but it is. Who is driving more now than they were before? Who is producing more now than they were before? Who's manufacturing more now than they were before? Nobody. But yeah, oil prices are going up. So watch for a correction in oil. I'm playing that in the Canadian dollar and the Canadian dollar, US dollar spot exchange rate. The dollar side of the exchange rate should just respond to the long in the dollar index. And the Canadian side, the short Canadian side, should respond to the expected short in oil. So far, opened a position yesterday, and it's up. It's profitable. Can't complain. The dollar with the euro, on the futures side. Again, no fundamental reason why investors should be selling dollars and buying euros from a macro standpoint, because Europe is going into shutdown while the United States is not. Buy dollars, sell euros. So that trade's finally starting to play out. EP. And I'm watching gold for the open this morning because I got a put on gold and actually it's a put on GLD. It's a little bit too expensive to get into a gold futures contract right now. And plus with the options, if I time it right, when the market's running in one direction or another, I can get calls and puts for cheap if I time it right. So I got to put on GLD, but because it's an option, on an equity, prices don't start moving until 9:30. So at 9:30, I'm expecting a jump in the price of the contract because gold is lower now than where it closed yesterday. More money for me. Oh, and it seems like I'm gonna lose out on an S&P E-mini or a put option on the S&P E-mini futures that expires today. I mean, the one thing I didn't need was for the market to just go sideways, and it's been doing that for the past 2 days, so I guess I gotta take a loss on that one. But, oh well. You win some, you lose some. That's what they say. Alright.